Welcome to Singular Research, Beachside Talk.
Featuring Robert Maltbie, CFA, President and Founder, and Alicia Velgos, Vice President. Here are some insights for smarter investing. Capital flows are still winning, but equity supply and CAPE risk are rising. Let's all hear from Robert about the latest market update.
Hello, I'm Alicia Velgos, Vice President of Investor Relations with Singular Research, and welcome to another edition of our Beachside Chat. This is going to be very exciting. The S&P 500 is trading near one of the highest levels in modern market history, and the chiller CAPE ratio is approaching its 2000 peak, and the 10-year Treasury yield remains competitive, and that's with the market's earnings yield. But yet capital continues to pour into the equities, and the ETF's inflow have reached record levels, and corporate buybacks remain enormous, and earnings estimates are rising, and then small caps and micro cap stocks are now outperforming. So the market is it dangerously overvalued, or is the equity still powerful enough to push stocks higher? Well, joining us is Robert Maltbie, CFA and President of Singular Research and author of the firm's latest macro market indicator report. Welcome, Robert.
Welcome. Thank you.
You're welcome to another edition of our Beachside Chat.
Yeah.
It's very, very exciting. So let's start with the headline that I just read. I mean, your report is saying earnings and, the capital inflow, they're still empowering, and valuation concerns, but that is, the gap is narrowing. So what does all that mean? Is the gap narrowing?
Yes, it means the market has two very powerful forces working in opposite direction. First, we have strong earnings going one way, and secondly, we have higher prices, higher valuations going the other way in a negative sense. The S&P forward PE ratio multiple is at 5 and 10 year, approaching 5 and 10 year record highs. The so-called Shiller CAPE ratio, of which I am not a big fan. I'll share it. Some people are. CAPE is cyclically adjusted PE, looking back 10 years. I think it's like rear view driving, looking through your rear view mirror, in my view. But anyhow, many are afraid of that. The ratio is extremely high. It is as high as it's been since the year 2000, and everybody remembers that bubble. So it's bubble, 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 bubble. It's not a cheap market, but what's being underplayed and appreciated is a tremendous earnings growth, largely driven by AI. That's where we are.
Right. And so your current macro market indicator score is 78 out of 100. So what is actually supporting that score?
The strongest components are earnings growth and capital inflows into the market. It would be much higher, but the valuations are negative because they're so high. So that's our balanced approach right now. It keeps us cautiously bullish.
Right. Wow. And so then one of the more interesting parts of your report that you just wrote compares investors' inflows with new equity supply, and from the IPOs and the ADRs and the SPACs and also the secondary offerings. So What did you find?
Well, um, the market is digesting an incredibly large amount of new issuance
Mm-hmm.
because there's a greater amount of new capital coming into the market at this time. That can change at any moment, but the balance is still positive for the market in that there's ample capital out there around over 7 trillion in money market equivalents that is sopping this up.
Mm-hmm.
That won't go on forever. Something may give one way or the other. But that's the current situation.
Right, right. And so there has been constant debates about the Magnificent Seven. And I knew you were very, very excited about the Magnificent Seven at one time, at one point. So are they still really the best place to be in your opinion?
Not as a group.
Oh,
Some good, some bad.
Mhm.
Some have really superior earnings growth and momentum, and some do not. So you have to be a little bit selective here.
right.
The other thing that is important is their valuations are high. Uh, their growth is high as well. But now, other sectors of the market have better PEG ratios than the Magnificent Seven. And that's where you want to focus. Excuse me.
Okay, great. Well, so small caps and micro caps have been major outperformers. You know, recently I've been watching them and seeing them as well. So, is that really still sustainable?
The rotation is real.
Okay.
Now, the Russell has materially outperformed the S&P 500,
Mm-hmm.
and so has the microcap index, even smaller stocks.
Okay.
A lot of that is catch up. During the dominance of the Magnificent Seven, these sectors were totally forgotten, and so you have to be much more selective now. You have to look for the higher quality companies that have the good cash flows, that have the low debt, and that are still trading at discounts to their growth rate, discount PEG ratio.
Mm-hmm.
They're out there, but now you have to look a lot harder.
Mm-hmm. Wow. And so, yes, you do emphasize the PEG, the PEG ratio, rather than the PE alone.
We like PEG.
Why is that?
Yeah. So PEG ratios tell a broader story. If you just look at PE or EV to EBITDA,
Mhm.
that the PE, price earnings, just tells you how much you're paying for the earnings, but it leaves out an equally important data point. What's your growth?
Mhm.
If you have high growth, you're paying a price. It'll be worth much more. The valuations will rise accordingly. So that's what you want to be very selective about right now: the PEG ratio and the growth rate.
Okay. So let's discuss the most alarming number in your report. It's the S&P 500 CAPE ratio, and it's above 42 and close to January 2000 level. So should investors be worried about that?
They should be aware, but not worried about it. I'm not a big fan of the CAPE because it's backward looking and we're moving ahead.
Mm-hmm.
So that's one thing. The other important element goes back a long time, 10 years, and it compares 10-year periods to the prior 10-year period, the prior 10-year periods. There's a massive amount of change that's occurred over the multi-decade comparables that have impacted profit margins and different inflation rates, different earnings growth rates.
Mhm.
So it's very difficult to take one number and say this is a great time and this is not so great time. For example, during the 90s, where we had a higher starting point in that CAPE ratio, investors did as well as investors in the 80s, where we had historically low PEG ratios. So it's not that easy.
Mm-hmm. Okay. Well, is AI still the strongest investment theme?
It remains one of the most compelling elements.
Mm-hmm.
driving performance, but still, you have to be very selective as the higher quality opportunities are in bottleneck areas where there's shortages, and where the demand is measurable. That includes high bandwidth memory, advanced packaging, networking, optical connectivity, power generation, storage, and semiconductor equipment. The market's beginning to distinguish between genuine AI beneficiaries in those industries, not just slapping a generic AI on something. So it's looking a bit more carefully at what's working.
Mm-hmm. And so how do you think investors should actually be positioned now?
Well, remain overweight equities,
Okay.
but selectively. We favor profitable small caps and microcaps. We like industrials benefiting from infrastructure and domestic capital spending, driven largely by the aforementioned AI. Financials benefiting from corporate actions, IPOs, secondary offerings, financings, and mergers and acquisitions. Very busy out there. AI infrastructure companies with visibility in their earnings growth ramp and a powerful position in the marketplace, a dominant position. And we are market weight mega cap growth. We think that's pretty fairly valued right now. We think that investors should keep enough cash in short-term cash equivalents in short duration T-bills bonds to be ready for these pullbacks like we're having right now in semiconductors. As a group pulling off 25-30%, which seems like a horrible experience. It is if you just bought, but this sector has rallied nearly 100%. So if you're a long-term investor and you're positioned already, you're still way far up ahead.
Well, what would cause you to be more defensive?
Well, three things. If earnings falter,
Okay.
that would be good. If interest rates unexpectedly rise, and if the equity issuance overpowers the capital inflows in the market, any combination of two of those three would not be favorable to the market.
Right. Well, do you have a final thought for us? And what would be the single most important message that you could offer our investors?
Don't make the mistake of calling a bubble
Oh, okay.
without looking at the earnings growth, or calling a bear market because there's been a sharp correction when the earnings are still supporting this. We're in the middle of the very beginning, actually, of the earnings season now, and the proof will be in the pudding, but the estimates are phenomenal for a continued high 20%, 25% growth. That should keep the bull market matriculating forward.
Wonderful, Robert. Well, thanks for joining us, Robert Maltbie, CFA, President of Singular Research. And so for a complete Singular Research macro market indicator report, you can visit for your 30-day free trial, singularresearch.com. Singularresearch.com. You can they email you, ask you questions, Robert?
Oh, well, they can.
Good.
Yeah, but
During
mainly
the 30-day free trial?
Yeah. 30-day free trial, include your questions. Happy to help.
Great. So go and sign up for 30 days. Enjoy your report, interacting with Robert Maltbie, the CFA President of Singular Research. Thanks for joining us.
Let's go to the luau. Have a nice summer.